Hey, good morning. Let's go over today's trade plan. So, as I mentioned in Tuesday's recap, markets that tend to go up relentlessly on light volume are prone to a correction. And we've seen that, the overnight session, we haven't had much of a correction, but we did get some responsive selling off that 78 to 80 resistance zone and got a pullback down to the 73 area, which was the prior resistance area, which acted as support. So heading into the open, we have 73 to 75 as the pre-market support zone, 78 to 80 as pre-market resistance. And as long as the market holds above 73 to 75, we know that the buy side is more dominant and in control. On the upside, we are at these short-term inflection points and some bigger picture resistance areas, with the all-time high being at 85.75, and we're trading within 10 points of that. And the problem and the challenge with this market for today is going to be that, number one, it's running on light volume, and second is that the market can move down 10 points just as easily as it can move up to that open gap and all-time high from here. So, it's a very mixed context, because we know that the market has been quite strong up to this point, but at the same time now it's hitting some decent resistance, and even though there's no big catalyst, the market could quite easily put in a pullback down to the 65.75 to 67.75 zone. As far as the econ reports go, we have FOMC minutes out at 1 p.m. Central Time, and normally it's not really a big catalyst, but because the market's quite overextended and because it's really the only report that's of importance today, it could actually result in some directional movement. So we do just have to keep that on the radar and just be mindful of the report at 1 p.m. Central. And because of that, the early morning session could be a bit choppy, and if the light volume continues, then it may not really provide any high probability, high reward to risk trade unless it's a break outside of the overnight range and a break of the overnight balance. Then there could be some momentum behind it. So right now, looking at the other markets, we've seen a decent pullback in TF that's signaling some weakness. NQ, has been making new highs on the year, got a little bit of a pullback in that. Nothing really significant as far as a pullback in NQ goes, or ES. So far the market is holding up really well. So heading into the open, you can use 73 to 75 as almost the micro bull bear zone. And if the market is holding above it, then you know that there's some decent strength that's continuing in this market, and we could be setting up for a move up to the open gap at 80.75, naked VPOC 82.25, and then we have some pretty decent resistance at 83.5 to 85.75. And first test of that zone can still attract responsive sellers in this market, but if we balance for several hours ahead of that zone, then you have to be cautious on the short side, because you could be setting up to make a new high and then perhaps you get some selling. But right now it's a very mixed context because the market is a bit overextended. We've been rallying basically every day, but on relatively light volume, and that's a reason for concern. So you do have to continue playing defense. I think it's good to be extra selective today, and that might mean no trades on the day time frame, right? Because if early in the morning we're running at light volume and the market's just chopping around without really much directional conviction, then there may not be any decent reward to risk setup that really even warrants a trade. So the best thing is to wait for a momentum push, wait for the market to kind of tip its hand to let you know which way the momentum is really leaning, and then try to get on board, as opposed to just kind of taking a trade blindly, expecting the market to continue rallying or expecting the market to crash lower or put in a pullback. I think it's probably better today, given the econ calendar, given the light volume, to let the market move in one direction, right? Let it break below 73 to 75, or let it show you some decent momentum to the upside before getting on board. In the event of a push below 73 to 75, 65.75 to 67.75 initial support zone would be the downside target. It's a spot where buyers can still be active and still step in. And if we break below initial support, then right below it, we have 61.5 to 63.5. and 56.5 to 58.5. Now, the 61.5 to 63.5 is a caution zone because it's right below initial support. So this is something that requires a real-time read, and it's a zone that you may need to skip if there's a lot of momentum on the downside below initial support. But 56.5 to 58.5 is a very high probability and pretty high odds area for buyers to step in for at least a rotation back up towards the 61.5 to 63.5 zone. So, first test of the zone can still provide a pretty decent bounce back up. And, even if we get a short-term correction lower, it doesn't mean that this is a weak market or that, overall the trend is changing and going to the downside. It would simply be a pullback within an uptrend. So, for those reasons, the 56.5 to 58.5 zone, if we even get a pullback that low, can still provide a tradable bounce back up towards 61.5, 63.5, and 65.75 to 67.75. On the upside, like I mentioned earlier, initial resistance is pretty decent, and if it happens ahead of FOMC minutes and the momentum's not there and the volume's not there, then it could be a short trade for a rotation back down towards 78 to 80. But again, the reward to risk is not that great, and shorting near the all-time highs when the market has been pretty relentless and Q has already made a new high on the year is a bit of a risky idea. So, it is better served as a target, but if it sets up in the right way where, let's say right off the open, if the market just kind of goes up towards initial resistance and the momentum's not really there and the internals are not extremely positive, then the market could still be stuck in a range and it could provide a short setup, but that's something that will need to be judged in real time. So right now above 73 to 75, defensive long trades are the core idea. Below 73 to 75, we can look for a short setup down to initial support, target this, and then this can be a potential long. In the event that we break initial support, 61.5 to 63.5 is a caution area where there may be a long setup depending on how the zone gets approached, and as long as we don't balance ahead of it for too long. 56.5 to 58.5, if we get down there, it's a pretty decent long setup for a bounce back up towards 61.5, 63.5, and potentially 65.75 to 67.75. On the upside, there may be a short trade, if the internals are fairly weak. I mean, they're not going to be weak when we're heading up there, but as long as they're not extremely strong, like the S&P AD is below plus 200 and the NYSE AD is below plus 1,000, and the tick is relatively mediocre, then there could be a short setup up here. But again, that is a little bit higher risk, because once you're trading near the all-time highs, then it doesn't really take a whole lot for the market to just make a new high, even if it's a marginal high, and just kind of clear out any stops that are near the all-time high or above it. So for that reason, and because of this mixed context, it's best to be extra selective today. And like I said, that may mean no trades on the day time frame. If the volume remains light and the range is not that great, then it's best to just conserve capital and wait for some better setups. So those are the main thoughts heading into the day. Let's see how well the buy side holds up above pre-market support, and let's see if the sellers can press below it in the event of a break, and we'll take it from there.